Hey there, Lincoln here from bullacademy.org. Inflation is staying high. It's continuing to rise. We don't know what's going to happen. We thought it was going to be transitory, said Jay Powell. We believed him. We continue to invest. And it continues to persist. It continues to rise. It continues to stay at record highs 40, 30 years in, rivaling or surpassing the 70s and the 80s. Inflation is here and it's staying for a while. And that means that the Federal Reserve is going to continue to increase interest rates. And that also means that companies that need to borrow money to continue to fuel their growth, or any company that borrows money, is going to be able to have less access to money, less access to debt, credit, which means that they're going to grow slower. And some may not be able to grow at all, because as all of this happens, as the interest rates rise, inflation continues to stay high due to the Federal Reserve's mandate to get inflation down to 2, 3, 4%. The stock market is falling. Investors are running away from companies and index funds that they once were highly invested in. And that means that companies now, along with not having easy access to debt, credit, money that is borrowed, they also may not have access to raising funds from the stock market at favorable terms, because their stock price is so depreciated, because investors have run away and their stock price is down 50, 60% from a year ago. So if they were to try to raise money now by issuing more shares, by selling shares to the public, they will be doing so at horrible terms, at lower share prices than they had a year ago. And that will increase dilution for not much in return. And shareholders don't like that, which will mean that the shares will go even further down. So if a company needs money today, they are out of options in this current environment. They can't borrow because it costs a lot more to borrow than it did a year ago and 2 years ago. They can, but investors also don't like to see high debt in these times. So the company is pretty strapped because they can't borrow, they can't raise money from the stock market at terms that will be favorable and accepted by their investors. And if they're a young company that doesn't have much cash on the balance sheet, they could end up going bankrupt. So things are getting very hard. And in order to avoid the worst case scenario, in order to continue to hang in there, companies have to take drastic measures, which will always start with their people, the payroll. They have to cut payroll. And that's why we've been seeing companies lay off employees in droves. And we're also seeing them renege on offer letters, taking away job offers that they gave out to candidates. They're freezing their hiring plans or slowing down drastically their hiring plans. And the job market is going to get tougher. Right now, we've been in the last 2 years where the job market has been on the side of the employee who has had all the power to move around the world and work from home and remotely and all of that, and have high salaries because companies were struggling to compete with the rest of the market as employees had all of the power. But that isn't going to last. It has to cool down. That's just how it works. In order for inflation to go down, people have to spend less of their money. And that means that in order to do that, in order for them to want to spend less money and have less money to spend, they have to be fearful of losing their job. They have to be saving. So with all of that said, I want to just give you 5 things that you can do in this environment to, one, survive this market downturn, correction, and maybe a recession if we get to that point, and also come out the other side better off, despite all of the horrible things that are happening right now and that could happen in the future. Everyone likes to refer to these times as wealth destruction periods, but it doesn't have to be so for everyone. If you take the right steps, you can make these times, and should make these times, these environments, a period of wealth creation for you and your loved ones. All you have to do is stay invested. In order to do that, follow these tips. Let's dive in. Step 1, save 3 to 8 months of expenses. Make sure that despite inflation and despite the fact that savings can be dwindled by 8% or 8.6% year over year, you need to save money. You need to save at least 3 to 8 months of expenses in case you lose your job, because these are risky times. People get laid off. Companies shrink their payroll in order to get through this environment. They stop hiring. They slow down hiring, which means that it becomes harder to find a new job if you are to lose your current job. So usually it might take you 3 months to find a new job after moving from an old job, but it might take you 6 months, maybe even 8 months, maybe 10 months to find a new job after losing your job. So you want to increase your nest egg by double, maybe even triple, to make sure that you can survive the worst case scenario, and that it might be losing your job. And the reason for that is because you don't want to have to pull money out of the stock market when things get rough. You want to keep your money invested. So you need to save money on the side that you can touch once you need it. Okay, so that's step 1. Step 2, to the same end, you need to invest in your career. As I said, layoffs happen and companies are going to cut those who they find to be non-essential to their business. If you are a highly productive employee right now, keep doing that. So if you're not a highly productive employee right now, I would suggest starting to be more productive. Starting to show that you're a crucial part to your team, that the company is better off with you than without you. Be more productive. Give more output. And if you are currently productive, be more productive. Doesn't hurt to be more productive within reason. Of course, don't kill yourself. Don't work 80 hours a week, but you need to be defensive here. In the next 12 to 18 months, we can see many layoffs across the economy, and you don't want to be a part of that. So you need to show your manager, show your team that they need you, that they are better off with you on the team, that you're highly productive, so that you are not in that list of people, 10% of the company getting cut, 25%. These numbers happen. So that's step 2. Invest in your job, invest in your career, survive the layoffs. Step 3, pay down callable debt. Any debt that can be forced to be paid at any moment, you should pay off as much as you can. Because you don't want to get into a situation where you have lost your job and the market continues to fall, and now your broker is saying, hey, your margin loan is due now. You need to add more money to your brokerage account to satisfy this margin call, or we're going to sell all your stocks or some portion of your stock in order to get you back to your margin maintenance requirement. You don't want to be in a situation of receiving a margin call that you cannot satisfy. It's not a good look. Creditors don't like that, especially if it ends up bankrupting you. So pay down as much as you can of that. It's a very risky strategy to involve yourself in. So if you are involved in that, you should have already known that. And now may be the time to pay down that debt so that it doesn't come up against you in the worst case scenario. Step 4, once you've done all of that, you have your savings, you have invested in your career, and you continue to be productive and increasing your productivity at work, and you've paid down your callable debt. Now you need to take the most important step, which is do nothing. Stay invested in the stock market. Stay invested. Stay invested. It's highly important because you only destroy wealth if you sell. If you sell, that's when you realize losses. If you're investing in great companies that you know, understand, believe in, and were planning to hold for the long term, now is not the time to sell them. Now is not the time to abandon that strategy just because others are fearful and they're selling off their stocks. Just because other people say your stock is worth less today doesn't mean you have to agree. You don't have to sell, and you shouldn't sell unless something has changed fundamentally about this company, and for some reason you don't believe that they can survive this downturn, this correction, this recession that might come, that they might go bankrupt. If those reasons don't exist, you should hold on, because eventually the stock market over the long history in the United States of America has gone up and down and then back up. It will eventually turn around. That's how our economy works, our markets work. There are cycles. There are booms and busts. Most of the wealth is made during the bust. When people and when everyone are running away from the stock market, those who end up building outsized wealth are the ones who buy at the dip. They buy the dip. Maybe they bought at the top, maybe they bought in the middle of the boom cycle, but then they continue to hold on and buy the dip, average down, take advantage of the dip. And then when everyone was getting excited again because things are turning around and there's so much exuberance in the market again because everyone's excited about the economy, the United States is going back into the roaring 20s and everyone's happy. When that comes back, as it will, that's how the cycle works, you will see your investment, right? That's what an investment is, to hold on and buy more, to acquire more equity in your individual companies or even index funds. If you're investing in index funds, same thing. You continue to hold, you continue to buy in, and now you're bringing down your average cost. And then once that market turns around, you're now going to see even greater upside. So if you're down 50%, if the market turns around and your company is worth what you think it is and can continue to grow in the next 5-10 years, it will eventually surpass where it once was. And so if you're down 50% to get back to where it was, that's a 2x return. That's 100%. That's basically free money over the long term. In the short term, might not be so free. It's very risky, right? Because stocks don't have to recover. They don't have to recover fully. They might go up a little bit and then just stagnate. But if you're investing in great companies they believe in for the long term, there is a great chance that that company will recover and you will be paid handsomely for staying invested in it. So stay invested. And number 5 is take advantage. That's pretty much it. Take advantage. Once you're staying invested, continue to invest 10 to 15% of your income. Money that you are willing to just keep invested for the next 2, 5 years, 10 years down the road, that you don't need, that you don't foresee needing, because you have a 3 to 8 months savings account in case you get laid off. You have your expenses taken care of. Now, if you continue to make money, you continue to have your job, you continue to be more productive, you get maybe even a raise during these times or a promotion, you continue to invest 10 to 15% of your income every month into your highest conviction companies, investments, and index funds if that's your thing. If you're not so big on trying to pick your own companies, that's fine. Most people shouldn't pick their own companies because you need to really do the studies to make sure that you have some advantage and that you're staying on top of the company in case things go wrong. And most people don't have time for that. So if that's you, if you just want to invest in the S&P 500 or the QQQ, whatever, Vanguard, that's fine. Stay invested. That's the whole point. Stay invested and buy more. Continue to invest. Because these times are not times of wealth destruction. They're times of wealth creation. Those who destroy their wealth are those who sell out. Those who exit the market because they didn't plan well. They didn't invest in companies that they knew, understood, believed in, and planned to hold for the long term. They did not practice the bull mentality. But you did. You've been doing this. You were ready for this. You followed the previous 4 steps. And now number 5 is just to continue to do what you've been doing. Continue to invest. Don't waver. Maybe sell some of the cul-de-sacs, the companies that you don't really believe in that much, and then double down on your other companies if you have to sell anything, right? Ideally, you don't have to sell anything, but if you do, take the opportunity to double down on the companies that you still believe in the most. That's what I'm doing. That's why I have a few companies. I can focus on a few and make sure that they really do well for me. And then the ones that I really don't really care about that much, let them go. That's how I decrease risk. Because having a bunch of companies that you don't really know and don't really study is risky. That's increased risk. But if you have a few that you really understand and you really focus on, you really dedicate all your time to studying and following and making sure that they're doing well and doing what they say they're going to do and continue to grow, you've decreased risk. Because now you have more knowledge than everyone else. Because they are investing in hundreds of companies because they think that's safe. But they're actually increasing their risk because they can't possibly follow all of those companies and understand all of them. So find a few companies that you still believe in the most and hold on to them, continue to invest, and dollar cost average down, and continue to acquire equity at cheaper prices. If you really believe in these companies for long term, this is practically free money. Again, if you believe the long term. Because in the short term, it's going to go up and down, and it might even go lower. But if you believe the long term, that is going to continue to grow and do well, you have an opportunity to buy at prices that give you 2x, 3x potential where the company's fundamentals have already been. So those are the 5 things. And I have one more for you. One last one. It's stay invested. Just stay invested. We've already talked about that, but I just want to touch on that again. Stay invested. That's all you gotta do. Hopefully you've planned well for these times. The stock market is gonna continue to struggle, and the Federal Reserve is gonna have to increase interest rates. We've covered how that works. We've covered that entire monetary policy, that strategy that the Federal Reserve implements to increase economic activity and decrease economic activity whenever they need to increase inflation or decrease inflation using the interest rates, right? There are 2 levers and they pull them to maintain the market equilibrium. So it's gonna continue to happen. We don't know what's gonna happen in June. We saw 8.6 in May. It might even stay at 8.6, 8.5, maybe even 7. That's still high. So we're still in this, and it could get worse. But those are the steps that you can take to make sure that you survive, and not only survive, but get through the dip and get to the top. I hope you enjoyed this, and I hope it proves helpful. I'll see you again soon. You have been watching bullacademy.org on YouTube, where we teach long-term investing by breaking down concepts and sharing the stories of companies to help you build long-lasting sustainable wealth. We hope you enjoyed this video, and if you did and want to see more like it, please remember to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts on this topic, even if you just want to say hi. Hi. I would love to hear from you, and I always do my best to respond to every comment. If you would like to engage with me outside of YouTube, feel free to follow me over on Instagram at Lincoln W. Daniel, where I share random thoughts on life and wealth building. As always, this video has been brought to you by our patrons at patreon.bullacademy.org, who support this channel financially to help us keep going and help me brainstorm new video ideas to share with all of you. We do this show together, and we do all of this in our private Discord chat, where we discuss the stock market in real time every day by sharing news, rumors, and new investment ideas, so we can all do our own research and then come back together and collaborate. So if you're interested in any of that, I hope you'll join us over at patreon.bullacademy.org. I'm Lincoln with bullacademy.org. Thank you again, and have a great day.